Well, hello, everyone. My name is Scott Mitchell with SDR Ventures, and it's my pleasure to moderate this second in a three-part webinar series aimed at constructively disrupting the business owner's ecosystem of advisors. By the end of the conversation, we want to answer the question, why is understanding and optimizing the business owner's ecosystem important? We'll be building on our last webinar, which was Unlocking Opportunities, an economic forecast and capital market trends for lower middle market business owners and their advisors. If you didn't happen to see the first webinar, just let us know and we can get you a link to the recording. In the discussion today, we'll address the following facts. Fact 1, owners considering a liquidity event through transaction to achieve family succession or buyout goals never wanted to be money managers, but that is where many find themselves post-transaction. For instance, the annual investment returns on a $50 million liquidity event might amount to more money than the annual cash flow of the business they just sold. Fact 2, the next chapter is often not what owners expected. Fact 3, navigating this transition puts them in a place of having to learn a new language and manage advisors as they step away from managing their employees. Owners go from watching KPIs in the business to watching the change in their financial portfolio. They go from having a sense of control over their business to being subject to financial market shifts. Fact 4, when advisors operate in the silos of their own disciplines, focused on the goals of their individual areas of expertise, the advisory community inadvertently introduces competing priorities, conflict, and confusion that actually increases stress for owners when what they actually need is clarity, confidence, and control to achieve a successful transition. I'm joined today by our panelists, Bob Dahl, Chief Strategist for Crossmark Global Investments, Jeff Eliason, Principal of SDR Ventures, and Dr. Ali Taylor, co-founder of Orange Kiwi. They understand these challenges and are committed to finding a better way to serve the unique needs of business owners and their advisory teams. Rather than a deep technical dive, we're going to focus on practical insights related to selling or family succession with the goals of, first, demystifying who you need and when to optimize an exit. Second, wading through the messiness of expectations and conflicts around valuation and wealth. Third, navigating misaligned shareholder priorities. And lastly, addressing unique opportunities that exist in the current equities and M&A environments. We want to start this webinar by giving Bob a couple of minutes to update us on noteworthy changes in the economic forecast since our August 10th webinar. Bob, take it away.
Thanks, Scott. Hi, everybody. As most of you know the investment management business and the markets, not much changes in a month, but there are always subtle points to make out, and I've got 5 of them. First, related to the engine of the U.S. economy, the consumer spending remains strong for all kinds of things. And that's on the back of consumers having jobs and having gotten wage increases. And so they're spending money because their confidence level is reasonably good. There's still money left over from COVID that's being spent as well, which has aided consumption. Number 2, oil prices. They were already moving higher when we first met in August, but they continue to move higher still and are threatening $100 a barrel. We won't get into a deep dive, but it's both supply and demand. Because the U.S. and much of the global economy, there are exceptions, has remained pretty strong, there's a demand for what it takes to run the world's economy, and that includes energy. And of course, on the supply side, we've had the United States for many months now curtailing the ability to put new holes into the ground. And we've had Saudi Arabia, among others, saying, this 1 month price high or supply cutback that we put in place, we're going to make it last 3 months. Oh, no, only kidding. We're going to make it last the rest of the year. And my guess it will last past that because they want higher prices. And of course, you'll have the whole Russia-Ukraine thing that's kept supply back as well. And as a result, number 3, and for some other reasons, inflation has remained sticky. Last week, we got an important CPI and PPI report, and there was news in those reports both for the bulls and the bears. But let's make it simple. Inflation's still running around 4%. Remember, the Fed has a target of 2%. I don't know about your math, but my math tells me 4 is a long way from 2. And so the Fed has more work to do or more prayers to pray. I don't know which. Maybe it's a combination of both. The Fed is meeting this week, and the consensus is, with which I agree, that the Fed will hold pat on interest rates, but they'll have a lot of telegraphing of information. Progress on inflation, economy stronger than expected, maybe some visibility into their likely pattern for the rest of this year. And my guess is that interest rates at the Fed level will probably be raised once more, either in November or December. And then the debate, which is already ongoing, when will the Fed cut rates? My view is there's no way they'll begin to cut them till they see the whites of the eyes of a recession. And point number 5, to the stock market, equities have turned sloppy. The stock market peaked on July 31st, and since then has been toing and froing. One day is red, the next day is green. I think we'll see more of that until we can sort out, are we going to have a recession? If so, what's it going to look like? Are we not going to have a recession? What about earnings? Earnings expectations have turned out a bit higher in the last 2 or 3 months as the economy's done better. But in my judgment, expectations for earnings growth for the United States are too high for 2024, even if we don't have a recession. So our outlook then and now is a little bit of caution. Don't chase things if you're in the public markets. Wait for your price. And if things get a little carried away on the upside and you want to let some go, we're not going to fight you there either. As we said last meeting, I'll say it again. You see on your screen, we put out a weekly publication at Crossmark entitled Doll's Deliberations, 10 points about what's gone on in the world in the last week and might go on next week, and then a page with an essay that kind of summarizes things. So that's the view, Scott. Back to you.
Thank you, Bob. Really appreciate your continued insights and updating us. So next, I want to move into a discussion about transition and specifically the significant transition challenges a business owner faces in exiting a business. Let's start with Ali. Ali, can you provide an overview of the 4 phases of transition that a business owner experiences?
I'm happy to. Business owner experiences 4 phases if they're done well. Early in my research, I ran into a guy by the name of Bo Burlingham, who wrote a whole bunch of books, Small Giants, The Great Game of Business, and the one that really struck me was Finish Big, How Great Entrepreneurs Exit on Top. What resonated with me about his book is he identified these 4 phases after interviewing owners who had exited. And he had a much easier time finding owners that had unhappy exits than he did finding owners that had happy exits. And what he found is the difference was owners that had happy exits went through this first phase, the exploratory phase. Owners that did not have happy exits skipped this phase altogether. And so this exploratory phase is foundational for successful transitions, because it's the phase where we define what does and does not matter and why it's important. We get alignment among all the stakeholders that will be involved, and we have crucial conversations that prevent non-productive conflict or frustration, confusion from derailing the transition. When we do this and we do it really well, it makes the next phase, the strategic phase, even more effective, because you're able to go into this phase when you're building your advisory team. Exit's definitely a team sport. It's not something that can be done by usually very well by your internal team. It's a phase of the business that is not normal. And it's going to cause owners to behave differently and to think differently, to manage their business slightly differently as they head towards the exit. And in this phase, owners and their advisors have to collaborate to develop the approach to market for the transaction and the strategy for the owner's post-transaction liquidity. And if we forget that second part, it makes things really messy when owners get to the last phase. Once we have a great strategic plan and we have built a really good advisory team, we can then start to go to the execution phase. And this is where, if you're going to transaction, either family succession and taking on some capital to complete the transition, or going to sell your business, your plans are implemented. And so you start to enter what's called the merger and acquisition market. And that's something Scott and Jeff can tell us a lot more about in a bit. As you enter this market, making sure that your team is playing well together and not operating their silos is the owner's number one job. They have to stay the captain of the team. And they have to prevent any one advisor from trying to dominate or take the process in different directions. It's really important that there's good, clear communication and coordination against the owner's goals, not any one advisor's goals. And then we enter the adjustment phase. And this is where the transaction, whatever it looks like, is done. And the owner goes on to whatever comes next, as does their management team and family members and their advisors. Some advisors, like your investment advisors, will stay with you through this period. They have continuity of relationship before, during, and long after the transaction. So it's really important to have them on board early. Their voice in the process really helps owners not only maximize their financial advantages, but have the support that they need as they move from being, as you said, Scott, managers of employees to managers of a set of advisors.
Ali, that's a super helpful overview. I want to take each of these phases one by one and do a bit of a deeper dive. Let's again start with you, Ali. So who do business owners need as they're just in this exploratory phase, and kind of when does it occur within the life cycle? Yeah.
So in terms of time in the life cycle, the best time to prepare for your exit is as early as possible. If you're doing a family succession, that typically takes 5 to 7 years, with or without capital. If you're getting ready to sell your business to really maximize the opportunity, the earlier you start, the better. Former McKinsey & Company consultant and management expert Tom Peters pointed out that the soft stuff is hard and the hard stuff is easy in comparison. And we think about this exploratory phase, it's about defining goals for your mom and yourself. And your mom is management, ownership, and money. And it's hard because it's 90% soft stuff, like values, needs, wants, hopes, dreams, emotions, psychology. And those go with the concrete goals of enterprise value, time, strategic priorities. The earlier you start to go through this process, and it is a psychological process. That's what I loved about when Bo defined these phases. They map how human beings move through excellent decision-making. And that's the reason that this phase is so critical, because these hidden parts will win every time. They're the fuel for decision-making in later phases. Once you have those on the surface, you have the clarity and awareness for how these parts of you will show up, and you get to gain confidence and control. And when you communicate it to your advisors, they can better support you through the entire process. So who do you need? You need a good facilitator, a guide, someone like a business psychologist like myself, or a really good coach that's been through this more than once. You don't want somebody who's never walked with an owner through transaction before. You start to interact with people like Scott and Jeff, investment bankers, to understand what the market value is. You're not signing a commitment, you're just kind of testing the waters. And you're starting to work, really importantly, with financial professionals who can help understand your estate, offer different estate strategies for you. And those strategies tend to be very valuable for you if you do them early. The more time you have, the more opportunities that are available to you. The shorter your horizon to exit, the fewer the opportunities.
Really appreciate that context, Allie. Jeff, this is but ahead of prime time for the investment bank. So how can they be useful in this exploratory phase?
Sure. You know, SDR works closely with business owners across the entire life of the business owner, and doing so in coordination with both the business owner and their family. And at this exploratory stage, we're going to really emphasize collecting data about the company, and what drives value for the company and what also detracts value from the company. In doing so, we're going to look at the financial statements, particularly top line and bottom line, what margins look like, draw comparisons between that and the peers, industry data that we have on that company, provide a comparative analysis to that end. We want a really thorough understanding of what the growth drivers that the company maintains, coach the business owner on how scalable the business is or is not, and how they can improve the scalability of the business. We want to begin to unearth the unique value proposition and niche that the business maintains, again, relative to their peers. Another important factor for businesses is how much recurring revenue exists. That adds to the value of a business. You also have value detractors that we want to identify and discuss with the business owner. Concentration across customers, employee responsibilities, vendors, suppliers can detract from the value of a company. We also want to understand the owner concentration. Buyers of businesses want to be able to pull the owner out and know that that business is going to run effectively without the owner. From there, we're going to talk about who are the buyers, both ideal and then maybe potential buyers that the business owner may not be aware of. And most importantly, perhaps, is of the potential buyers, what are they willing to pay? Because it's one thing to say what the business is worth on paper or according to the financials. It's a completely different conversation when it comes to what are the universe of buyers willing to pay, and most importantly, what are they paying for in terms of adding to the business or detracting from the value of the business. And at SDR, at this exploratory phase, because we've been doing this for over 20 years, we have a really good sense of who the universe of buyers are. They have a very acute awareness of who we are in the marketplace, and we can have anonymous fireside chats, if you will, and give that business owner a blueprint coming directly from the buyer as to what their interest is, what they're willing to pay, and what they're actually paying for. And so with that, we have a great opportunity in this exploratory phase to really equip that business owner to prepare their business and be exit ready.
Thank you, Jeff. And Bob, lastly, the business owner's assets are tied up in the business at this point and off balance sheet. So how can wealth strategists and investment advisors provide perspective during this exploratory phase?
Certainly, as everyone said so far, this is a process. You don't wait for the event and then start the process. You've got to start your process so it's pretty well defined by the time the event occurs. And it's typically a liquidity event where some of those assets that you really can't touch and take to the grocery store or on a vacation today, you're able to do that. Now, what are you going to do with them? What are your goals? What are your long-term? What are your short-term goals? How much risk are you willing to take? Is this about capital preservation? Is part of it capital preservation and part of it going to be growth capital? Are you thinking about the next generation or generations? And so you eventually need to zero in on a financial advisor. You don't just decide right up front. You can talk to several, and each of them will give you a few ideas, and you'll find some chemistry with one, and maybe that's the direction that you go. It takes a long time to get this right, and the longer, Ali already said this, the longer in advance you start, generally the better the plan's going to be. And you can also change your mind. You know, if you've not done this before, the first time is a very interesting time and often the only time for people. And as a result, you want to get it as right as you can. Not that you can't change things along the way, but to get off to a good start is important. Ali used the phrase, this is a team sport, and it certainly is. You're not going to go to just one person and say, solve all my problems post the event. You're going to have a group of people you talk to. The financial advisor will be the centerpiece long term, as was already mentioned. But what does that financial advisor look like? You know, there are financial advisors, there are estate planners, there are tax attorneys. Depending how complex your transaction, you need to consult all of them along the way. Then there's the actual investment of the capital, which is going to take place afterwards, but these plans have to be made. At Crossmark, we do both of these. We do consultation with people and have financial planners who help the process along. And most of what we do is, after decisions are made, managing the assets, stocks, bonds, alternative investments. So thinking about all this, for many people, it's a foreign language. You know, they know their business cold and can do it in their sleep, but post the event, you don't want to be lost. You want to have some grounding and understanding and education so you can ask the good questions.
Thank you. Well, that's a great dive on the exploratory phase. So let's go to the second phase, which is the strategic phase. And we'll start with Jeff on this one. And this is, again, the strategic phase is, hey, we probably haven't decided exactly when we're going to start the liquidity event process in earnest, but it's maybe a year or two out from that. And so, Jeff, what advisors are critical in this phase?
Thanks, Scott. So being about 2 years out, we recommend a number of different assessments that are kind of a diagnostic test of both your personal and professional readiness for an exit. I break that out into 3 different sections, which will then inform the experts that you need on your team or on your bench. And the first is owner readiness, particularly when you have multiple owners within a business, and even more so if they're family members. Ali is going to talk more about that and what that means at Orange Kiwi. The second area is financial readiness, and Bob did a great job talking about the wealth manager in particular and their ability to determine the business owner and their family's financial readiness for exit. And certainly within that area, you have other experts in addition to the wealth manager, such as an insurance specialist, a tax specialist, your estate attorney. And then, of course, business readiness is the third area. So you have owner readiness, financial readiness, and business readiness. SDR is going to play a big part, and an investment bank will play a big part in defining whether the business is ready for exit and giving a roadmap, if you will, a checklist of what it's going to take to make that business ready. And not only ready, but you want the business to be what we call a grade A business, particularly in this current market environment. Grade A businesses are not only selling, but they're selling for a premium relative to historic multiples. Other businesses that are not grade A businesses are struggling to sell, and oftentimes they're selling for a discount. So at this point of being 2 years out, you want to work with an investment bank like SDR to determine what's driving value, who the buyers are, and what the buyers are paying for, as I mentioned in the exploratory phase, and then establish that roadmap that is going to give you the highest and best probability of reaching your objectives. Some other key members of the team at this point is also a charitable strategist. If you are charitably minded and your focus is also on minimizing taxes, you want to begin establishing those charitable strategies at this point in time, about 2 years out. Why do we do all of this? Well, for a couple reasons. One, we want to close the gap between the owner's expectations and what the market expectations are, and align those 1 to 2 years out from exit. The other thing that we want to do is an analogy that we like to use at SDR. The sooner we can establish how far the field goal is that we're kicking, where the goalposts are across the entire team, the greater probability we have of kicking that field goal, more specifically defining what the objectives are for the family and the business owner, and establishing the highest probability possible of reaching those objectives. And this can only be done if we establish the team, put everybody in the same room, and make sure that there's open lines of communication.
Bob, how does the approach change or sharpen, I guess, with the investment strategist as we're reaching this pre-market period?
I start by saying, if you did nothing about this in the exploratory phase, now's your chance with a little bit of fire under your belly to really get moving. You can make up for lost time, but you got to get started on all the things that we all just talked about. I think that if you think running your business is complicated, wait till you get to this phase. Expectations are all over the place, and so communication is important. If you're the sole owner and you've got a family and they're going to be part of this, you got to talk to them, because when you sell your business, somebody in the family is going to say, when you sold your business, I thought blankety blank blank, and the next one's going to say, no, I thought this. You need to have the conversation, and you might want to solicit their opinions as you begin to craft, what are we going to do with this, in many cases, massive amount of capital that's come our way because we've run a successful business for years and decades. And that can then begin the process of narrowing down alternatives. A lot of these planning phases, that's what they are. This is the opportunity set. This is the possibility set. How am I going to narrow it down to works for me and my family and the capital we have in front of us? You need to start thinking about the difference between the short and the long term, the generational comments that I made earlier. Are we going to use mutual funds? Are we going to use separately managed accounts? Some of you say, I don't know the difference. Well, that's a point in time in this phase to get educated on these sorts of things. What are my possibilities? What are my options? What are the pros and the cons? Tax consequences, as Jeff mentioned a few minutes ago. So it's just a more precise, more concise, more necessary part of the planning process.
Ali, I imagine that this is a mentality shift for owners as they go from sort of the theoretical to the actual and the executable. So how do you see what's critical here in this strategic phase?
Yeah, I really appreciate Jeff and Bob's comments. All that hard technical information that has to be translated and analyzed and decisions that have to be made are going to be stirring emotions, and it's going to be stirring confusion. So for some owners, they hit this phase. If they haven't done the exploratory work, their head starts spinning 1,000 different directions because they didn't have the time to do really good processing. For those owners, it's this phase can be really helpful if you go slow. It's going to be the strategic phase will be much longer, and it's even more important that they take time in vetting their advisors and making sure that their advisors play well together. They wouldn't have done that before. When you're sitting with an advisor and they're all speaking different languages and they're all asking you for the same information 10 different ways, it gets confusing. So having somebody come along and walk alongside you to say, this is what Jeff's asking for, and this is what Bob's asking for. And guess what? It's the same thing. So let's just give them this one document. That's all you have to worry about. And having an advisor team, I know Jeff and Bob and Scott, you guys really well. Playing as a team makes it easier, not only on the owner, but on the advisors, when we can have a common language and those open lines of communication that Bob mentioned. And so here it's really all about helping the owner ensure they remain the team captain. When they're having those fight or flight responses, fight, flight, or freeze responses, it's having a safe space away from advisors to be able to go through your questions and your reflections, be able to refer back to the work you did in exploratory phase to get really grounded on what's important to you and what's not. And in this phase, if you picked an advisor in the exploratory phase or even at the beginning of strategic and they're not fitting in, now's the time to replace them before you move to execution.
Thank you, Ali. Sometimes people don't make the team, so that's a good reminder. All right, well, let's get in then to the fun of the execution phase. And so this is when we're getting into the meat of the liquidity event process. You've actually decided for sure we're ready to go to market, and or with family succession, it's we're having the conversations about that transition. And so everyone, I think, generally thinks of this as the investment banker's time to shine. But I actually want to start with Bob. Bob, how do investment strategists and estate attorneys support owners prior to the liquidity event actually taking place, as the options start to really take shape?
Yeah, we're now, the rubber is now meeting the road. And this is the point in time when having done good planning, interaction among these various professionals can make this piece a lot smoother. For example, if the deal structure from the investment banker has not been consulted with the financial planner, you could be losing lots of dollars in taxes or otherwise. So this is an important time to make sure that the team is operating by understanding each other, where the investment people and the deal structure have spoken to one another, as it were. The team now it's game time. The team is on the field and has to execute, to use the word, the plan that has been made over time. And I emphasize it before. I'll emphasize again, I probably will do in our conclusions. The more planning you do, the higher the probability things A, will go smoothly, and B, things will go well. And who doesn't want it to be a good experience and executed to the best possible ability? So getting people together, the dialogue between them, and have somebody every once in a while say, chill pill, time out, relax. because stress levels, I've seen it, you've all seen it, I see you all laughing, and stress levels can go very high.
Jeff, how long does this execution phase typically take? And how do the advisory team work well in the same sandbox, and what happens when they don't play well together?
Sure. Well, it takes about 9 months on average from when the engagement is signed to when the deal closes. And the team that's in place is going to play different roles over the course of those 9 months. Very early on, just before the engagement gets signed and as the engagement gets signed, the wealth manager is very involved in establishing the goalposts with the family and the business owner. And what that looks like is, what are the family's needs, oftentimes across multiple generations upon the exit. And that is some really deep conversations and soul searching on what the business owner's desire is, not only for their immediate family, but oftentimes across many generations. And then from there, pulling in the estate attorney to talk about how to establish those needs and objectives across multiple generations and across the entire family system and family unit in a very healthy way. In addition to the financial advisor, oftentimes the charitable strategist will be involved at that point, sometimes in terms of a donor advised fund and gifting shares of the company to minimize taxes. All of those things need to be done very early on, if not before the engagement gets signed. Finally, the wealth manager is going to work with the family and the investment bank in establishing cash at close as it relates to their retirement readiness. When deals close, a large sum of money is not simply wired to the business owner's account, and the business owner does not leave the keys to the company underneath the doormat for the next owner to take over. Instead, there is a percentage that is cash at close, and then oftentimes there's an earnout. And so the wealth manager needs to be very involved at that point in understanding what the strike price is of the business, what percentage is the earnout, and how that works in coordination with the family's needs and objectives, particularly post-close. As we move on through the investment banking process, you see a number of attorneys get involved, an M&A attorney, a real estate attorney. Oftentimes, as buyers are doing due diligence on the company, they may not be happy with how the books were kept over years. And so the business owner may have to have a quality of earnings done on the financials. They may have to have a bookkeeper or a CPA actually clean up the financials so that they are acceptable to the rest of the buyer universe. And we then take the deal to a close, and oftentimes attorneys help us do that. What happens if this is not accomplished, if these teams are not working together? The goalposts move. And when the goalposts move, it's a bad day for the business owner. It's a bad day for the wealth manager. The only people that are happy are the attorneys that are charging by the hour. It's a bad day for everybody else. So we've got to establish those goalposts and determine what our probability of success is. Scott?
Wow, I didn't know this this webinar was going to include lawyer jokes, but I've got 3 or 4 if you guys want them. Ali, investment bankers love to get together over a cocktail or two and commiserate about, being blindsided by the irrational behavior they're experiencing from business owners during the execution phase. Why is that so common?
Because it's the most emotional phase. And you can only process so much emotion until you're faced with the reality of hard decisions that are right in front of you. It's also the phase where if you haven't told anybody on your management team to this point, you're definitely going to be telling your CFO, probably other key employees are going to be necessary to get through this. So you're now confronted with other people's emotions. And remember, emotion's not a choice. It's a biochemical and physiological reaction to stimuli incoming. And so you can't control the emotion. And people that try to stuff it down and deny it during this phase tend to be the ones that are more prone to blindsiding their advisors because they're going to have to process it one way or another. And so you often hear them give you a business reason why they need to pull the ejection cord for what is really an emotional process. And owners just want the pain to go away. They're also often confronted with what the market says their business is worth, which if we haven't dealt with the emotional premium up to this point, or they're not a grade A asset, it tends to be a little bit more challenging to work through those parts of it. And so the owner, as they walk through the execution phase, it's really incumbent on the advisors not just to be checking boxes and gathering documents and running fast. They have a lot of work to do and they're really busy, but it's really important to pay attention to the clues that the owner is giving us as we're going through this process. When the first thing that they tell us, how you doing today? I'm okay. You need to go a little bit deeper. You need to make it okay, because for owners, as we go through exiting our businesses, we're going to be completely reshaping our lives from the moment that business closes forward.
Thank you. Well, we're going to head to the last phase, which is the adjustment phase. And, as we approach this phase, I just remember really a time in investment banking before I really thought about these four phases. We had just closed a deal and we're at the celebratory dinner after the closing. And, this owner kind of looks me in the eye and he says, "You forgot to tell me something," and kind of this accusatory, look in his eye. And I was just immediately panicked. Oh my gosh, was there some deal term? Was there some escrow? And I said, "Oh my gosh, well, what is it?" And he said, "You forgot to tell me when they announced the transaction that I'd be bombarded by 25 wealth advisors telling me that they wanted to manage my money." So that's how the adjustment phase can kind of go wrong. But let's go in order here on this final phase. Jeff, what happens with the transaction team, the M&A investment banking team during the adjustment phase?
Well, Scott, sadly, this is where most investment banks just disappear, and they leave it to other groups to pick up the pieces as they move on to the next deal. At SDR, we are incredibly intentional, though, to make a very clear handoff of the baton from our team to likely the wealth manager or the family office coordinator that is really best equipped to take that family into this next chapter or stage of their lives. Our mission is to work with business owners in making that stage post-close as significant and as purposeful as their life was while building a business, preparing to sell that business and selling the business. And we take that very seriously. And the only way that happens is if there is a very clear handoff of the baton from our team over likely to the wealth manager or family office coordinator.
And Bob, obviously, business owners are bombarded with lots of options on the investment strategy front. What does the relationship look like with a high-performing investment team, and who stays on the team from pre-close to post-close?
For starters, hopefully there aren't 25 who call where anybody's going to return the call, because you've already selected your investment advisor. You know who your financial planner is and what that's going to look like. Now you're just kind of filling the accounts with the designated dollars that have been selected and decided upon beforehand. So another way to say it is, once you get to this phase, Jeff already said it, passing the baton, the financial advisor becomes the quarterback. And yes, still taps into these other people as needed, but that's the person that's going to have the ongoing responsibility and opportunity to meet the needs and financial objectives of the person who sold the business. Yes, the financial advisor or the family wealth office leader will have a tax person, a legal advisor, people on the team that can help when needed. And when you come to the word adjustment, yes, it's for the person who's sold their business. It's a big life adjustment. You hope you don't have to make too many adjustments in the financial plan because you thought about it in advance.
Thank you, Bob. And Allie, no matter how much preparation and how intentional everything is, all it really does is increase the probability of a successful transaction. So we should probably address both. There's an adjustment period, successful or otherwise. Can you speak to that?
Oh yeah, that's a really good point, Scott. Whether or not the deal closes, owners are going to go through adjustments. So if the process fails or goes on pause, owners have to regroup, and there's going to be a pretty strong emotional response to that. Those who just want to go make the pain go away and run back to doing business as usual will miss really valuable lessons. Those who pause, really take an objective look at what happened, can work through the parts of themselves that maybe cause things to go a little askew, and then reconcile it with what the market is telling them to improve their business, will get a better outcome the next round. And when the process is successful, all of a sudden they go from, like we started the webinar saying, I think you said, Scott, they go from managing employees to managing advisors, and that's a very different experience. So as they go through this new process, it's really giving themselves permission to recreate themselves. And one of the best ways to do that is with peers, other owners that have been through a similar journey, or with a really good, as Bob said, family office advisor or wealth advisor who can build that relationship, and they're not just there for as a part of a transaction. It's not a transactional relationship. It's a deep personal relationship where they actually care about you. And some owners don't want that. Some owners are wired much more logically. They don't want a deep relationship. They still have to have somebody who will sit and listen and help ask good questions so they can continue to make good decisions as they go into this next phase.
Well, this has been a super enlightening discussion around the 4 phases of transition. And so lastly, with our panel, I want to ask a question. If you had one piece of advice for owners considering an exit in the next 1 to 5 years, what would it be? And to set the table for that discussion, I wanted to provide just 2 stats that I find very telling. In a recent survey by UBS, 81% of business owners said they wished they had spent more time preparing for sale, and 40% say they've not engaged their heirs in a dialogue about family wealth. So why is preparing for exit such an uncommon practice for business owners? And I think it just boils down to it's a once in a lifetime experience. They don't know what they don't know. Most business owners are happy to use a tax CPA specialist each year to do their taxes, but a liquidity event just isn't something that's a part of their routine. But at the end of the day, it's almost impossible to optimize your exit if you don't use the right specialists. And so just resist the temptation to DIY is sort of my take on this one. It's almost a guarantee to a suboptimal outcome, and not just on the economics, but on the other aspects that we've talked about in the business owner's life. So with that, I'll turn it to Allie. Allie, what's the one piece of advice you'd give to business owners preparing for exit?
I think Carl Jung said it best. Unless you make the unconscious conscious, it will drive your life and you'll call it fate. And that's never more important than when you're making significant decisions, like you will as you go through these 4 phases of transition. And all owners in this space have to do the hard work of deep personal change, and that can be painful. Why don't people talk to their heirs about family wealth? Oftentimes it's because they want to avoid conflict, and money and splitting up money and dividing money and what's fair tends to bring on a lot of conflict. My argument is that can make it productive instead of unproductive by being intentional and doing the planning.
Bob, how about you?
I'm going to quote Scott Mitchell. 81% wish they had spent more time preparing for the sale. That's what I was going to say before you put this up. Get started. Just get started. If you know this is in your future, you don't have to dot I's, cross T's. Write it down. Write down some of your plans, because when it's on paper, you can criticize it and change it. And the second thing I was going to say is talk to your family, talk to the heirs, whoever that's going to be. And I guess the third thing I would say, you said 1, but I'm going to give 3. The third is be prepared to see your life's going to change. Yeah. Many are in control of their businesses. And when you get past the event, you're not in control anymore. Yeah, you make the decisions and the buck does stop with you, but you need to be now engaged as a team. Be prepared for that.
Thanks, Bob. And Jeff, close us out.
Got to feed off of both Allie and Bob. When we talk about getting started, I think it's absolutely imperative to pull in a coordinator that is going to hold you accountable, create that roadmap, and take you through the roadmap in a very systematic, methodical way. And the coordinator could be an executive coach, a business consultant, a peer group like Vistage, YPO, C12. It could be a business psychologist like Allie and her team at Orange Kiwi, your wealth manager, an exit planning specialist. These people are all trained in their own way to guide you from point A to point B. And without them, I find that it's very, very difficult to travel that journey on your own.
Thank you, Jeff. Well said. Well, we left about 5 minutes for Q&A. So I believe that folks can enter some questions. If we don't get to your question in the allotted time, no worries. We will answer your questions over the next couple of days and get back to you. Also, just a reminder that our final webinar in this series is coming up on October 23rd. And it's the 3 E's: economy, elections, and exits. So it should be a good discussion as we gear up for a year's worth of debate around the next president and changes in the federal government, among other things. So,
Scott, I have an owner texted question. And it's for Bob. Bob, oh, sorry, I have to make it bigger, my old eyes. Not all financial advisors are created equal. Who is best positioned to design a strategy for an exiting owner?
I'd say number 1, somebody who's done it before, has a little experience. But even more important than that, it's somebody that you have chemistry with. You've got to like this person. You've got to trust this person. You've got to be able to share some, deep, dark secrets perhaps with this person about what your plans are and the things you're worried about. So it takes some time. You got to build that chemistry. They need to know what they're doing, and they need to get along with you. They're the two requirements.
And he had a second question for Jeff. Jeff, what are the warning signs that you've got the wrong investment banker?
Some of the warning signs are that the investment banker is tone deaf to your needs. And when I say your needs, I mean the family's needs very holistically and comprehensively. So if you're dealing with an investment banker that is myopic and focused only on the transaction and getting you nothing more than the most money possible for your business, then it's clear that they are thinking about one thing and one thing only, and that's the deal. Secondly, if they are completely unaware of the team that needs to be assembled around you, then they're thinking about one thing, and that's the deal and the transaction, and nothing more, nothing less. So think about those two things. Be on the lookout. Those are clear lines of both success and red flags that you're working with the wrong person.
And the next question, Scott, for you or Jeff, he wants to know, when do investment bankers start charging fees? From the exploratory phase? ?
Scott?
Yeah, from the very first email. No, just kidding. No, it's really typically at the time that we say, hey, it is, it's time to actually start preparing to go to market in terms of building the materials, the confidential information memorandum, to actually, when the owner has established, yes, we are for sure wanting to sell.
Awesome. And I got a great big thank you for both of you. And we are at the top of the hour, Scott. So if there was only one other question, it was a logistical question. So I think we got that handled.
Great. Well, if any other questions do arise, please let us know, and we will send out a recording of the webinar as we follow up. But it's been a pleasure to have everyone today, and enjoy the rest of your day today, and we'll be back with you on October 23rd. Thanks, everyone.
Thank you.